Well, hello there. Thank you for joining us today. My name is Martha Inyuma. I'm a fire partner at TSAVO. TSAVO is a real estate investment company based in Nairobi. We focus on small units, one bedrooms and studios where you can buy and rent it out for monthly income. Today we have a very exciting topic. I hope this will be very beneficial to you as you make your financial decision, as you start your financial independence journey, or while you are at your financial independence journey. We hope that this will be very impactful. Let's see you at the comment section. Let's hear your views. It would be just nice to see, what your perspective is. And today's topic is mortgage versus payment plan. I'm laughing because this is one of the biggest questions we get at TSAVO when people are coming to look at our investment plans and just wanting to start their financial independence journey or owning a home. So just to give you a bit of history, the word mortgage is from the old French language that means death pledge. Yeah, so mort, which means dead, mortindum, and gage, which means pledge. And so according to them, it's it's because when the deal dies, if the deal dies when the debt is paid or not paid, because there's repossession. Yeah, and just the general meaning that we all understand is a legal agreement by the bank or a financial institution where it lends money on an interest rate based on collateral value, so whatever you use to get the mortgage. Yeah, and so the most commonly accessible mortgage is the floating rate, where it's a bit adjustable, meaning if when the rates in the credit market are high, the mortgage rate of the repayment will be high, and if the credit rates are low, the mortgage repayment rate will be lower. And so, of course, as we start this, I know very many of you who are watching might be at different levels. So there are others who've already taken the mortgage plan option. There are those who are in the process of doing it. There are those who, are weighing between mortgage or cash purchase. I hope this will be very helpful to just, guide your financial decision or just help you in your financial budgeting towards financial independence. Of course, for those who know about TSAVO, we are very passionate about enabling our investors achieve financial independence. And even those who watch us from wherever, wherever you interact with TSAVO, we hope that with this knowledge sharing, you're able to make better financial decisions that will enable you in a few years to become financially independent. And so I hope that will give you something today to help you. And maybe just to answer the big question in the room, or to attack the elephant in the room, why mortgage? As a TSAVO, we don't offer a mortgage plan. Of course, it took time for us to really understand our business model and look at the factors that affect the business model. And one of the key factors was affordability. So very many Kenyans are looking for investments that are quite affordable, but at the same time, they want accessible financing. And very many people would look at us and say, mortgage is accessible financing, but we weighed the options, and so are we able to offer something else other than the mortgage option that would allow someone to have accessible financing but at still affordable investments? Yeah, so let me just paint a picture of how the mortgage plan works. So assuming you have something in the your payslip looks a bit fat, assuming you're worth mortgage of 15 million. So you go to the bank, you're able to borrow a mortgage loan of worth 15 million, which will be paid in about 15 years, yeah, at an interest rate of, say, 14% per annum. Meaning your interest rate in the next 15 years will add up to about 11 million. So whatever you borrowed at 15 million, you're going to end up paying it you're going to end up paying it at an interest rate of 11 million, which is 14% per annum, meaning your total payable amount is 36 million. Already that is I think looking at the numbers that way just gives you a bigger perspective of what this is. Yeah. And so assuming you're paying the bank over 15 years, meaning roughly you're paying the bank about 200,000 a month. And assuming that you have done the best decision, so you buy the apartment and you decide to rent it out until you clear off the mortgage plan. In a good scenario, in the situation that we're in at right now, if you have an apartment worth 15 million, maybe let's say roughly you're getting about 80,000 a month, yeah, and you're paying the bank 200,000 a month, meaning every month you're removing from your pocket 120,000 over and above the 80,000 that you're getting, yeah. Does it make, does it give you worth the money? Maybe it's up to you to think about it. And of course, we would want to see the comments on the comment section to just see what do you think? What do you think? But that's the reality on the ground. And so other factors included high interest rates. So of course, you've seen the 14% per annum, considering it's a floatable, mortgage plan, meaning it changes. So if the market rate is high, it won't be 14, it might end up being 17. Yeah, so high interest rates really discourages an investor. Yeah. Another thing is risk. So yes, life happens. Yeah, we have seen what COVID can possibly do to your financial situation. You can be laid off. You can get sick and you're laid off. So life happens, and so you've borrowed today 15 million. In the next 3 years, you're able to consistently pay whatever you're required to pay in the bank. But then life happens, and so you're not able to pay. So you end up with a risk of repossession because the bank will definitely take the apartment back. Fluctuation based on market rates. Of course, I have mentioned this is it's a floating mortgage, meaning you started at 14, you might end up at 17. On the other side, you could have started at 17 and it goes lower to 14%. Of course, if you're a bit familiar with mortgage planning, you need to pay a facility fee upfront of about 3% of the value of the mortgage. So if it's 15 million, so it's 3% of 15 million is paid upfront to the bank. And then there's rigorous due diligence that is done on you as the client, because it takes a while. So if you're looking at this as a run to option when you're financially in a bad place, this might not be the quickest way, simply because the process at which you need to go through to be able to be approved for the loan, it takes time. It really takes time, simply because of the due diligence that it requires. And so with all these factors considered, we thought, what is the easiest way to go through for someone to still own property, especially in the real estate space? And when people talk about real estate, there's just that shiver that it's a very expensive venture. But how can we make it affordable and accessible to very many Kenyans? And so we thought of, when you're looking at interest rates, then someone of course needs the reverse of that. So we've offered a payment plan that is on a flat rate, meaning if you're taking a 1 year, 2 year, 3 year, 4 year, whatever it is you're taking, payment plan, you pay consistently that amount. So for example, if you're taking a 5-year payment plan on a studio, it goes to as low as 25,000 a month. Whatever is happening in the country, whatever is happening in the market, whatever is required of you is 25,000 a month. Another reason why we chose the payment plan is flexibility. So today you have started on a 1-year payment plan, meaning you've done 20%, you've started paying the 100K or the 90K a month, and then life happens. Yeah, we allow you to be flexible. You can move towards a longer payment plan. So instead of paying 90,000 a month, you end up paying 30,000 a month. Yeah, so it just allows an investor to be more flexible. Another thing is affordability. So if you look at the payment plans that we offer, yeah, your monthly installments could be a savings amount, because you see, because when you look at our target, we target someone earning 100K and above. Meaning, if you're earning 100K and above and you're taking a 5-year payment plan, you end up paying 30% of what you earn. So it's something that you can actually quickly save towards paying your monthly installments, even over the weeks. Yeah, and another thing is no risk. Of course, you never lose your money. Yeah, so whatever you've given us, if life happens and things become very thick, yeah, we have very many options that just suit the investor. So number one, we can either refund you 100% what you paid us. So you paid us 1 million, life happened, things went bad, we refund you 100%. That 1 million. Another option we give you is to downgrade. So I remember when COVID happened, very many people were affected, and so someone could have taken a 1-bedroom. A 1-bedroom is worth 2.7 million, and they've paid about 1.8 million. We have an option to downgrade, so you end up paying 1.7 for a studio. So instead of retaining the 1-bedroom, you still get a unit. You downgrade from a 2.7 million to a 1.7 million, and over and above that, you already have 100,000 as buffer. Yeah, meaning if you're really, really stuck, you're able to downgrade, and we're able to refund you the 100,000 to just sustain you for the very few months before you get your things in order. Another option is just now to be moved to another project. So there's someone who has really, umejikaza, you've been paying, then life happens, and you can't pay no more. You have the advantage of just moving to a new project where you'll be slightly ahead of the payment plan, or you'll have just more time or more grace to raise the money and now keep paying. So we saw that this really eliminates your risk as an investor. So you can't lose your money. So you have all the options that you can deter to. And then, of course, no facility fee. As you come in, you only need to show capability that you can actually afford the unit by paying the 20%. Yeah, and we've given an option that you can either pay 20% or spread the entire purchase price over the construction period. So once you've been able to demonstrate that you're able to actually pay the 20% or spread it across the construction period, you're allocated a unit. So there's no facility fee that you're supposed to pay. And again, the last one is it's real time. So once you've done 20%, you're guaranteed to get a unit. Once you've paid 20%, you're allocated a unit, and it's not, you don't need to do much due diligence to access the investment. Yeah. But as I started this video, I said very many people who are watching us might be at a different level. So you might already have taken a mortgage plan, or you're in the process of processing a mortgage, or you're thinking about it. Yeah. And so the advice I would give would be, if you already have accessed mortgage options, yeah, so you're already on a mortgage repayment plan, try as much as possible to clear the mortgage. Try as much as possible to, fast track the repayment period. So for example, if you've taken a 15 million plan, don't wait for 15 years to end up paying 36 million. If you pay it in 5 years, you pay it slightly less. If you pay it in 10 years, slightly less. So be diligent, have all the coins, all the cents that come to you go towards repaying for that mortgage. Yeah. Also, if you're in the process of processing the mortgage, make a better financial decision. Try to think, what if I'm getting a mortgage worth 3 million, how much value am I getting it for? Yeah. So say, for example, if you're getting something worth 3 million, then, and your repayment plan is X, then whatever you're going to gain from that apartment needs to be equal or more than what you're paying the bank. So if your mortgage plan, if you're supposed to give a repayment amount of 200,000, wherever you're putting that mortgage, the rental income or the return on investment needs to be 200,000 or above, so that you're not going back again to your pocket to pay the bank. Yeah. But in all honesty, try and fast track your repayment plan. Try and fast track your payment towards the bank. Yeah. And of course, how do you come up with an accountability system that you're able to track where does your money go? Because sometimes, even beyond mortgage, we really run to get, personal loans, even from as simple as, the mobile, very quick loans. Yeah. Are you able to account for each and every cent that you borrow, so that whenever you're saying you're going for a loan, you're able to demonstrate that you're taking a loan worth this, you're going to put this money in X, and this is what you're going to gain as profit, and the profit will be returned back to repay the loan. But with all that, if you're capable, try and look at options that will enable you to access, investments, enable you to access assets without necessarily taking a loan. Yeah. So if you're able to get a payment plan that is a bit more flexible, or you're able to get some bit of cash that will give you a cheaper option instead of getting a loan, are you able to afford to build? Are you able to get land somewhere and start building? Would it be a cheaper option? Try to target to weigh options before you make a decision on your financial plan. Yeah. Then once you've weighed the options, you're able to see, if I go for a loan, this is what I'll pay after the end of the repayment period. If I don't take a loan and I have this piece of land, I can build at this cost. Is this cheaper? If I'm building at this place, is it accessible to my working area? And plan accordingly. And of course, if you've already taken a mortgage plan, how are you able to increase your value at your working area, so that you're able to increase your salary, and whatever coin that is coming, just throw it towards the mortgage to complete it. I hope that was fruitful and impactful. I would like to see your comments on the comment section. Let's engage. Let's challenge each other. Let's gain this financial independence together. Thank you.